Supply chain financing is a cash management tool that allows companies to extend their payment terms to their suppliers. It involves a third-party financier, such as a bank or a platform, that pays the suppliers earlier and collects the money from the buyers later. This way, the buyers can improve their working capital and cash flow, while the suppliers can get paid faster and reduce their credit risk. However, supply chain financing also has some drawbacks and risks. For example, it can obscure the true financial health of the buyers, who may rely on this tool to mask their liquidity problems or debt levels. It can also create operational challenges for the suppliers, who may have to deal with different terms and conditions from different financiers. To address these issues, the Financial Accounting Standards Board, FASB, approved new rules on July 20, 2022 that will require companies to disclose information about the key terms of their supply chain finance programs. The new rules will apply to public and private companies that report under U.S. Generally Accepted Accounting Principles, GAAP, starting from fiscal years ending after December 15. The new rules aim to provide more transparency and consistency in how companies report on their supply chain finance programs, so that investors, creditors, regulators, and other stakeholders can better understand their financial performance and risk exposure. How will the new rules affect conglomerates and small businesses? The answer may depend on several factors, such as the size, industry, credit rating, and competitive position of the companies that use supply chain finance. For conglomerates, which are large corporations that operate in multiple industries and markets, supply chain finance can be a useful tool to manage their complex and diverse supply chains. However, under the new rules, they will have to disclose more information about their programs, such as the amount of trade payables that are part of the programs, the interest rates and fees charged by the financiers, and the impact of the programs on their balance sheet and income statement. This could have both positive and negative effects for conglomerates. On one hand, disclosing more information could improve their credit ratings and attract more investors, who may appreciate their transparency and accountability. On the other hand, disclosing more information could also increase their borrowing costs or reduce their competitive advantages if they reveal that they are heavily dependent on supply chain finance or that they have unfavorable terms with their financiers. For small businesses, which are typically less diversified and more vulnerable to market fluctuations and disruptions, supply chain finance can be a lifeline to survive and grow. However, under the new rules, they will also have to disclose more information about their programs, which could pose some challenges for them. One challenge is that small businesses may not have the resources or expertise to comply with the new rules, which could increase their administrative burden and cost. Another challenge is that small businesses may face more scrutiny and pressure from their buyers or financiers, who may demand more favorable terms or conditions in exchange for providing supply chain finance. Therefore, small businesses will have to weigh the benefits and risks of using supply chain finance carefully. They will also have to monitor their cash flow and working capital closely and avoid becoming too reliant on supply chain finance as a substitute for sound financial management.